Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and welcome back to the Debt Management Masterclass, where we're going to be talking about the final video, which is financial efficiency, turning debt into wealth. Now, this is kind of one of those topics where I think it kind of has that notion of it can kind of sound a little too good to be true. And I know for me, when I hear things that sound too good to be true, I kind of turn my brain off. But I'm going to encourage you right now to not turn your brain off, to not switch away, because what I'm going to go through here can be one of the most important things that you can learn when it comes to your personal finances. Obviously, we've been talking about the importance of cash flow with our debt management, right? Like, not all debt is bad. It's about managing cash flow. For us to reach our financial success, we got to be thinking about investing for cash flow planning, managing our debt accordingly. And now with this, what we're going to be talking about is with the debts that we take on in life, whether it's lifestyle debt or consumption debt, whatever it is, how do we do it in the most efficient way possible? Because when we do that, rather than transferring more money away from our life than we need to, we can recapture some of that money simply in the way that we go about that process. And so I think this is one of those areas that's very misunderstood by a lot of people, but we're going to get into it, and we're going to land the plane on this series and go from there. So this is one of the most important things that I want people to understand. One of the keys that I learn from some of the most successful people I've talked with is this idea of opportunity cost. If you don't understand opportunity cost, you're never going to be able to make the most financially educated decisions possible. I don't care what it is. There's always an opportunity cost to every decision that we make in life, period. Especially when it comes to our money, okay? So when it comes to opportunity costs, this is one of the things Nelson Nash said in his book, Becoming Your Own Banker, but he says you finance everything in life. You either pay a bank, and when you go to a bank and access their money for financing, you are paying interest expenses to the bank. You're paying an interest expense to the bank. But if you go and pay cash, right, you can go pay cash, and when you do that, you may feel like you're paying cash to eliminate this interest expense, but the bottom line is you're losing the opportunity to earn interest on this cash. And so there's an opportunity cost that comes with that, because you lose the interest that you would have earned had you financed, right? And so the thing is, there's always an opportunity cost, a finance charge. And so what is the best way to do it? Now, a lot of people will say, and I'm going to address this, but a lot of people would say, well, if I could go finance at 5% and I could earn 5%, this would be a wash, right? Like, it's 5%, 5%, it zeroes out. So it's that's kind of the net of it all, is like, well, it's a wash. Why would I pay cash or why would I finance it when I could pay cash and just have more stability, not have the risk, so on and so forth? Well, I'm going to show you in this video how you could actually finance, and I'm going to give an actual example, at 7%, earn 5%. So most people would be like, I'm paying 2% more in interest than I'm earning, so that doesn't make any sense. But this is where I tell people math and money are different. Money math is different than traditional math, because you got to understand the moving parts and the different variables in the mathematical money equation, right? That's what it comes down to. And so what I want to do is I want to use this one example. And this example is a $50,000 car, okay? I'm using this example because of the fact that I think everybody that I know will buy a car at some point in time in their life. They probably, if you're like most people in this world, you're going to have 7 to 9 cars throughout the period of your life. So the idea here is saying, all right, we go and we buy a $50,000 car, and let's say we're buying a $50,000 car every 5 years. You see, we have 1 year, 2 years, 3 years, 4 years, 5 years. So every one of these periods is a 5-year period. It's assuming that we're doing a 5-year purchasing cycle on a car. Every 5 years, you're going to buy a new car. Now you can see that I have 1, 2, 3, 4 cycles. The average person is going to have 7 cycles of car buying cycles throughout their life, and so they're going to have 7 to 9 cars that they buy. Some people buy them faster. Some people, take a little longer. Obviously, we're dealing with averages here, and we're going to be talking about the concept, but the principle doesn't change. That's what I love about these concepts, is that they're principle driven, and the principles behind everything don't change. Now, let's get into first and foremost here. So now let's talk about this. I'm gonna come down here and I'm gonna focus on this section right here, which is this concept of being a debtor. Okay, this is what most people do. They go into debt and they pick up $50,000 in car debt. $50,000 in car debt. They go into debt and then they pay it off year by year, right? They go through and they pay this debt off, and they go up, and by the end of 5 years, they get to this point. The car is bad, they finance it, and they get another car, they trade the other car in, and it is what it is. So what we see here is that if you go and you get a $50,000 car and a 7% loan in a 5-year term, you have a $990 a month payment with total interest being $9,400. So this $9,400 right here, this is an 18% increase on the car. So now you got this $50,000 car, plus you paid $9,400, that's $59,400, right? That's an 18.8% increase on the price of the vehicle. So, you know, most people would look at this and remember, it goes back to our opportunity cost conversation. It's like we finance everything. We used a bank in this situation. We paid $9,400 in costs. That increased our cost of that vehicle by almost 20%. Well, you know, people that are sitting there with cash would say, well, why would I do that if I can just eliminate this cost, and that's going to increase my financial efficiency, is what they're saying, by 18.8%. And so I'm going to go pay cash, right? And so what happens is people say, all right, I'm like, you know, while most people do this because they don't know how to delay gratification, because let's face it, in order to do, partake in these cycles, you actually have to save money every single year. You have to delay gratification. Delay grat. That's what you have to do, right? You have to go through 5 years of doing this, and then what do you have to do? You have to get to this point right here, and then you got to spend it down, and then you buy the car, right? So the difference is, this first car buying cycle is the hardest cycle for people who buy cash, because you got to drive a lesser car for 5 years while you save up to get the car that you desire. And let's face it, most people don't have the discipline to do that. That's why people fall into becoming a debtor. So while I'm not going to make the argument that being a cash buyer doesn't come with a little more security, because it does come with more security, because let's say at year 3 here, you run into challenging times. If you have challenging times here and you can't make your $940 a month payment, well then, and if you don't have any savings to back yourself up, well then you're in trouble, right? You could have your car repossessed, there could be negative consequences on your credit report and all these different things. So you got to make sure you manage this accordingly. The thing I love about the cash comparatively is that you drive a beater car for a couple of years and you at least have, 3 years of savings going towards this $50,000 car. Probably got 20 to 25 grand sitting in an account at this point in time. That's a really beneficial thing for you, right? Like you're certainly more secure. But the bottom line is, when we get to the end of this 5-year cycle, we're going to spend it down and we end up at zero. We got to save. Remember, it's all about cash flow, because that $940, if we're saving for a $50,000 car every 5 years, we got to get to 50K, right? We got to get to 50K at the end of every single year. Otherwise, at the end of this period, this means we got to be saving. We have cash flow that's going in towards saving towards this amount every single period, or we're going to have to fall into, at the end of this cycle here, we're going to have to fall into becoming a debtor on the next car, right? So at the end of the day, whether we're making a car payment down here of $940 a month, or we're saving $940 a month-ish for our next car, it doesn't really matter, right? Like, cash flow is cash flow. There's cash flow coming out of our life for this car, which is the lifestyle expense. Now, I'm not a big believer that we should be making decisions. Like, there's a lot of people out there that preach what I'm preaching, but they do it a little differently. They try to convince you that you can make money on your cars, like get rich by buying cars. Well, I'm never going to tell you, and that's stupid to me. Like, you're never going to get rich buying depreciating assets. But what I will say is that you're human. I'm human. I love my Jeep. I love my camper trailers. I love, doing all these things. I like toys. I like doing the things that I love to do. I've got a dirt bike and I've got all these things that, are fun. I'm not going to get rich buying them, but if I'm going to buy them, I want to buy them in the most efficient way possible, because it goes back to this conversation. I want to control opportunity cost in my life. And if I finance everything in life, that means everything that ever goes through my life, if I could focus on increasing financial efficiency on every single thing, if I could just increase the financial efficiency by 1 or 2% on every decision I ever make in my life, now I can achieve my financial goals without having to chase big returns and taking on unnecessary risks in other areas of my life. So here's what I want to do. I want to get into this. Now, what is the cost of paying cash? A lot of people remember, because this person paid the $50K to avoid the $9,400 in interest expense, right? That's what happened. That's why they did it. So the question is, what's the opportunity cost of paying $50,000? If I could put my $50,000 into an account earning 5%, that 5-year growth grows to $63,814. That's $13,814 of gain. Now what I do is I got to go here and I say, all right, this is the cash gain. And then this is the bank interest that I would pay, right? If I minus those out, this basically says that paying cash in this scenario would be a $4,414 mistake, okay? Like when we look at this, that's what that's saying. Mathematically, from a financial efficiency perspective, paying cash for the car would ultimately be a $4,414 mistake, okay? Now remember, that's only over the first 5 years, okay? The challenge is when we've taken that $50,000 and we've spent it, we've done one thing, because remember, one of the most powerful components of finance is compound interest. When we take this account and we spend it down, to zero, and we got to start building up, what have we done? If we were earning 5% on this, we've interrupted the compounding by spending it down. That's the effectiveness of a loss, rather than continuing to grow from here. We go and start all the way back down here. That is the problem with the way that people typically handle it when they're paying cash for items. Now here's the deal. When we go through this, if we look at this over a longer period of time, $50,000 grows to over $216,000 in a 30-year period. So over 6 car buying cycles, just that first car, the way that you manage that first car, has a potential long-term opportunity cost of $216,000 at only 5% interest, okay? And you could do that right now with zero risk, right? Like that is one of the things to take into consideration. And remember what I said right back at the beginning. I'm going to show you how you could finance at 7% and only earn 5%, which most people think, why would I do that? It's going to be a 2% loss, but you're actually earning more. Why? Because the 5% here is compounding, and the 7% is amortized. So your interest gets less and less every single year, and compounding gets more and more. That's the difference between these two things, right? So coming back to this concept, what I want to say is, like, I've already said it a little bit, but I want to like kind of land the plane and take it to the next level, right? Is that, yes, I agree that paying cash is better than being a debtor in a lot of situations, because of control, because of financial stability, and there's an opportunity cost to that stability. And so it depends on what kind of stage in your financial structure that you're at when it comes to building your emergency fund, building your opportunity fund, and doing some of the other things that we've talked about to this point in time, right? However, what I love to show people is this concept of being a wealth optimizer, okay? And a wealth optimizer is saying that, hey, if we have people that buy an average of 7 to 9 cars throughout life, and we go through this period where we're saving, right? And you could see these green lines here. These just show the need to delay gratification. This would be the first period of time where you're saving money to capitalize for your first car, okay? And what happens is, this is what we're doing when we're utilizing a whole life insurance contract. Now, one of the things with whole life insurance contracts is that you're saving, the money's going to grow on a guaranteed basis, uninterrupted. It's going to grow long term, about 5%. Long term IRR, okay, is going to be about 5%. But here's the deal. The difference is, rather than utilizing a bank and rather than paying cash, you're going to borrow against the value of your cash value in your policy. And so what happens is, a lot of people like Dave Ramsey will say, well, it doesn't make sense to borrow your own money. Well, you're not borrowing your own money. You're actually going to earn 5%, and you're going to pay the insurance company 5%-ish, right? These numbers can vary a little bit, but I'm going to keep it really simple for the case of this illustration. And like, you know, just so you know, the right now rates at the time I'm filming this are about 5%. They can go anywhere from 5 to 8, or like up to 8%, and I've seen them as low as 3.5%, right? There are other strategies that we utilizing what we call cash value lines of credit through banks, where we can even get the rates down, and we can kind of pivot and toggle back and forth between utilizing the whole life loan provision and the lines of credit. But the bottom line, it's about controlling cost of capital, because that's how we're going to control opportunity cost the best, is by controlling cost of capital. By having my money in a whole life policy, it does a couple things. It makes it so my money is going to grow on a guaranteed basis every single year, and we're going to take advantage of the compound interest curve, right? It makes it so I can leverage against it, so I can borrow while I'm earning, I can borrow against it. But all the while, when I borrow against it, if I have $50,000, for instance, if I have 50K in cash value right here, I can borrow against it, but I'm not interrupting the growth of the money that I borrowed against, right? That money is going to still continue to grow, even though I'm leveraging it and utilizing it, and I've got it in play down here, using it to buy the car. So by the time I pay that car back, pay the loan back to have the car paid off, my account value is actually going to be higher than what it was when I started. And that will continue and continue and continue. And I can show you, and I've done studies on this based on like the average person buying cars, and these 7 to 9 years of cars that, 7 to 9 cars that people buy. And I showed you here with this one car grows to $216,000. Obviously there's costs, there's other things that go into it, because it's not just a pure $216,000 that you're gaining, because you are picking up interest expense, because you do have to pay, there will be some costs in here for interest, but the difference is you're going to be earning more than the interest that you're paying from a long-term perspective. I'm not saying that you're earning positive arbitrage, because that's not what it's about. It's about a volume play, and it's about a long-term growth curve perspective, okay? Now, with that said, this is where I'm saying you can pay 7% and earn 5% and still come out ahead because of compound interest growing for you, because of the fact that you're paying amortized interest. And in fact, with whole life insurance, you're actually paying simple interest, which makes it even better and more working in your favor. So what I will show you, though, is that by doing this and going through 7 car buying cycles, of 5 years, you'll have over $250,000 in cash. So if we do this over 7 years, if you start at 30, that means by the time you hit 65, you'll have $250,000 in additional cash. That's more cash than you would have if you made the same decision and either paid cash for the cars or finance those cars through a bank, okay? That's one of the, like, I'm not saying you're going out and doing anything different. This is making the same decision to buy the same cars, have the same lifestyle. I'm not telling you to live it up and buy a car that you shouldn't buy. I'm telling you, if you want to buy that $50,000 car and you want to go out and you have it, and that's the car you're going to buy anyway, okay? If you do that, rather than doing the bank, rather than paying cash, if you do it through a properly designed whole life insurance contract and you go here, I could show you mathematically on a guaranteed basis how you will have nearly $250,000, if not more than $250,000, more than the alternative. That $250,000 is more than the average American has saved at 65 years old for retirement, which is just over $220,000. So when you look at that, that's what I'm talking about. This is financial efficiency at its maximum. When we start talking about cash flow, remember, it's all about cash flow. When you buy your car, you either have to spend cash flow saving and then spending it down, and then cash flow is going back into saving for the next car. For lifestyle, because lifestyle requires cash flow, right? That's fair to say. You know, if we go into debt, we're using cash flow to pay our loans back every single year. Cash flow is going to pay those back. Either way, at the end of these 4 car buying cycles here that I've got illustrated, you're still ending up with, you know, no car or a car that's 5 years old, and you got to keep doing cash flow going forward, or you got to go back into debt and keep going cash flow for the next car. You either, if you want to keep having another car, that's just the reality you live in. And so what I'm showing you here is a way that you can recapture money that you're transferring to the banks, that you're losing an opportunity cost, and it's getting you to think about it through these terms. And I'm not saying, listen, here's what I'll say it differently. We go through this world where, I'll do it this way. We live in this world where interest rates go up and down, right? Interest rates go up and down. And so what you do in a down interest rate environment versus what you do in an increasing interest rate environment will vary. And in these rates where they're flat, they're going to vary. Now, for the past 30 years, we've been in this down rate environment, and then things got a little flat, and now we're kind of ticking up. So what we do here changes a little bit. But the bottom line is it's all about controlling the cost of capital. And this is, if you can control the cost of capital in every environment, and you can have financial tools that put you in the driver's seat to be able to do so, it makes it so you have more leverage and you can make better decisions and you can control opportunity cost. And if you can control opportunity cost in a way where most of the money going through your life, you can recapture 1 to 2 to 3% of that money just in inefficiency of money that you'd be transferring to the banks or losing an opportunity cost by paying cash, that's where you can recapture this money, and that's where you can create more wealth. And this is just, think about this. I'm just showing you this one example on one car. For the average home that has 2 cars, like a husband and a wife that goes out, we're talking about, you know, having $500,000 at retirement. That is, I don't know about you, but that is like wildly powerful for the average American family. And so my encouragement to you is to really take this to heart and really dive deeper. Take all the information you've gotten out of this course and realize like you can implement this in your life. Understanding cash flow planning, implementing cash flow indexing, learning how to implement whole life insurance as a foundational asset in your life from a debt management perspective, and understanding from a long-term perspective how utilizing whole life insurance can actually help you recapture money you're losing unknowingly, unnecessarily, and reposition that money to create wealth for you and your family going into the future. Not to mention all the living benefits, the death benefit, and everything else that will come with it. I know this may sound crazy to people, and maybe you haven't thought about life insurance in this context before, but I promise you, if you take some time and you really educate and do a deep dive, I know I didn't get like super comprehensive into the ins and outs of how it all works. I want this to be kind of a high level. If you want to get with somebody on the team that can actually help you, walk you through and show you illustrations and like go through numbers and see what it would look like for you, go down and link in the description below, click on set up the clarity call with the person that shared this video with you, or if you're on YouTube, go and check it out there, and somebody from the team is happy to help you, and we can go from there. But I know that this whole debt management thing is the key to success. You can't be scared about debt, but you can't be irresponsible with debt either. We got to be about cash flow planning. We have to utilize cash flow indexing for our debt management, and then we have to make sure that we understand how to control and optimize our wealth creation by controlling opportunity costs. So hopefully you found value in that. If you have any questions, comment in the comment section below. If you haven't already, make sure you subscribe, hit the bell, that way you're notified every time I launch a new video. Hopefully you enjoyed this debt management masterclass. The next one that we're going to be coming out with is the Financial Efficiency Masterclass, which is going to take this to the next level. We're going to continue this conversation. It's all being done intentionally in sequential order to be able to add more value to your life, to kind of educate you down this process. So make sure you go check that out, and we'll see you there. Till then, have a blessed, inspirational day. We'll talk soon. See ya.